In the last chapter, we covered bonds or debt instruments. In this chapter, we're going to go over stocks or equity interest, if you will, in a company, ownership in the company. Meaning that you are, well, if you can be a debt owner or an equity owner. They're both owners of the company in essence, because you have dibs, you have a stake in the company. Traditionally, if a company goes belly up, if it goes bankrupt, what would happen is the debt or the bondholders would have first shot at the value of the assets. If the company goes through bankruptcy, it's sold off, so on and so forth, and the value of the company should be, say, $1 billion, but it's sold off either in toto or in parts or whatnot for $500 million. The first folks that are in line for being paid have traditionally been, and by law, have been the bondholders. That's changed a bit, but in general, that's the idea. And that's also the rationale behind, by the way, the interest rate that's being paid to bondholders is a bit lower typically than stockholders. Anyway, so investing in stocks, quickly, identify the most important features of common and preferred stock, explain how to evaluate a stock investment, analyze numerical measures that cause a stock to increase, decrease, describe how stocks are bought and sold, explain trading techniques used by long-term investors and short-term speculators. Again, there are all kinds of strategies that are out there, and schemes, games, and rational strategies nonetheless for the most part, but there are a lot of pitfalls, things to watch out for when we're talking about stocks and or bonds for that matter as well. But again, stock is ownership in a company. When you own a share of stock, somebody asks you, well, what is your stock worth? Well, you have to go and take a look online to see what the value of your stock is at that moment, particular moment in time, right? Anyway, identify the most important features of common and preferred stock. Common and preferred stock, two concerns for beginning investors: where to get the information, what does the information mean? Common stock is the most basic form of corporate ownership. Equity stock is equal to equity financing. The reason why corporations issue stock, why they issue stock, is to raise money in order to start or expand their business, pay ongoing business expenses. They're trying to meet, when they issue stock, they're selling shares of the company. So it's going to be diminishing the shares of the current shareholders, or the value of the current shareholders, but money is being paid to offset that, if you will, to buy into this. And hopefully the rationale is that with the more money that's being injected into the company, it's going to do what? Go back out the door in terms of the company itself investing in new machinery and equipment, if it's a manufacturing type company or whatever it is that they're selling to grow their business, to make it grow more, because if you can increase the size of the pie, that is also going to increase the value of the company, of that pie, if you will. That's the idea, the general idea. Dividends are not mandatory. Dividends are voted on an annual basis, and dividends are what they're ownership in a stock, in a share of stock, for example. The bondholders are paid on a regular basis based upon what the terms are of that payment. Whether they're paid at the end, you pay $500 for a $1,000 bond, then you're paid $1,000 after 5 years. That's one way of doing it, so you know, kind of with some certainty. Whereas with bonds, with stocks rather, there are two ways in order to realize some income, if you will. One is through dividends. Dividends are what are paid on a regular basis, an annual basis. Typically, it could be quarterly, semi-annual, and it's what's left over, how profitable the profits for the company, what happens to those profits. They can either be reinvested in the firm, in the company, or they can be distributed to the owners of the firm, who are the shareholders. The shareholders, the stockholders, are the owners of the firm. The common and preferred stockholders are the owners of the firm. Dividends are those would be included in those annual payments. You still have ownership in the company, but you're paid a little bit. It's profit sharing for owners, so to speak. You get the idea. And the takeaway from that is that shareholders are paid in two ways. One would be in terms of dividends. These are those payments like an annual type payment, maybe, maybe not, because again, there's something, dividends are not required. And that also impacts the desirability of the stock. If you can get dividends, pretty regular dividends, consistent dividends, people like that consistency, being able to count on that interest income, or excuse me, that income associated with dividends. The other piece of that is that you could realize a gain on your stock purchase is that if you bought Apple today, 5 years ago, and a share of stock in Apple, and it's gone up 3 or 4 times over the course, maybe you paid $200 for it then, and now it's worth $1,500. That the difference between the $200 and $1,500, that $1,300, is what's referred to as capital gain, what you gained. So you can be paid that way by cashing in, so to speak, on your investment. So those are the two types that we're looking at. But in this case, we're looking at dividends, and dividends are at the pleasure, if you will, of the directors, of the board of directors, if they're going to pay out dividends or not. Shareholders have voting rights and elect the board of directors, so they're the ones that can drive that. The common stockholders, if you will. Income from dividends, again, cash, stock dividend, dollar appreciation, the stock value itself, what we just talked about, that's capital gain, possible increase in value from stock splits, meaning that stock splits mean that, say, for example, the reason this happens is these are marketing reasons, really, is what it comes down to. So Apple stock might be worth, I keep saying Apple, I should look up what the value is. Let's just say $1,500. And that's kind of pricey for a stock. People like to own a share of stock. They don't like to pay $1,500, maybe, maybe not, but we'll just say in general, they would prefer not to pay $1,500 for a share of stock. So to make it more marketable, make it more saleable, make it more cheap, so that more people can actually purchase that stock, the price, they may say, well, we're going to do a 2-for-1 split. So you're going to get 2 shares of stock worth $750 a piece, rather than having that initial share of stock at $1,500. So it reduces the share price and just increases the number of shares of stocks that are outstanding. And again, that has to do with marketability, etc. There's no guarantee the price will go up after a split, so that's another thing too. But anyway, that's the rationale behind stock splits. Declaration date, board of directors vote. When they vote to pay a dividend, record date, stockholders must be registered on the firm's books to receive the dividend. Record date, meaning, you don't just buy it the day before the dividend is issued. Ex-dividend date, second business day before the record date stock begins to trade without the dividend. Investors buy after the ex-dividend date do not receive the dividend. Okay, it's something to keep in mind. Payment date is the date that the dividend is actually paid. Middle investment between common stock, equity, and corporate bonds. These are all things to walk through, but I'll fast forward through these. Stockholders know the amount of cash dividend when the stock is purchased. Conservative equity position like common stock is usually non-voting. Dividends paid before common stock dividend, not a legal binding obligation. The company must pay. Dividends may be omitted by action of the board. It can be changed, in other words, at any time. Evaluating a stock issue. This is a new stock coming up or a new issue of the current company stock, and you can walk through the different types of investments that would be involved in that. The internet firm's homepage, again, you can get as much information. They typically post their annual statements, their financial statements that are out there available for you. Of course, um, you can always look this stuff up online. So, and I can't do it at the moment for whatever reason, but you can look up and see what the price of a share of Apple stock is at any given time, basically. And Yahoo has their page where you can walk through, and Wall Street Journal has their page where you can walk through, and you can go to the company's homepage and you can walk through and see what's happening in terms of their stock prices, etc. The trade price, the annual dividend is listed, the dividend and yield, the PE is the price earnings or earnings per share. And what that means is that how much overall is earned, that the price of the stock, $75 and $75.43, and earnings per share based on per share is $14.13, which gets us to $5.34 there, the PE ratio, if you will. Various stock advisory services, and they most again charge fees. Perspective. This is when you see the company's perspective on the stock. That tells you all the details about the company, about the income statement, the balance sheet, the financials, and they're usually dozens of pages. The prospectus to get a sense of what the company is all about, and so on and so forth. Anyhow, you can go through again the corporate earnings. These are listed typically on a quarterly basis. Earnings per share, corporation's earnings divided by the number of outstanding shares of stock. Again, earnings per share, the higher that it is and the increase, you're looking at changes, the delta. That's if it goes up, that's generally a healthy sign. There are a lot of different ways of evaluating or valuing stocks, and anyway, we'll kind of stick with a few things as we go forward here. Price earnings ratio, or the PE, is the price per share of stock divided by the firm's earnings per share. How much an investor is paying for a company's earning power. How does this? What is the current situation? Where is it going? So on and so forth. So if there's a PE ratio that's greater than 20, investors are optimistic. PE ratio is lower than 20, lower earnings expectations compared to firms in the same industry. So you're constantly looking at ratios, and ratios are rules of thumb. Not all ratios are pertain or apply to all situations. So meaning you've got to drill down and look at more information. Projected earnings, EPS, and PE based on historical data or future expectations are more relevant, and the future is changeable at best. Dividend yield, annual dollar dividend divided by the current price per share. Dividend yield increase, it's a healthy sign, of course, perhaps. Total return, dividend plus capital gains. Cash plus price appreciation, book value per share, the assets minus liabilities divided by the number of shares. So where it's at that moment in time. Market price per share is often greater than the book value. Other factors that influence the price of a stock, the beta, that's the volatility, that's what we talked about, that risk that's inherent in the marketplace. The volatility of the stock relative to the market has a beta of 1.0. So that's kind of on average. The higher the beta for stock means greater volatility, the greater the risk. The greater the risk, the higher the return, and also the greater the possibility that you could have diminished earnings, or the company could fail. At any rate, all these things are part of the calculation. The price an investor is willing to pay is determined by the expected future dividends, the potential increase in price, price uses time value to present the present value of the first two, meaning that what's embedded in the share price of a stock of Apple is what the future, what the expected earnings are kind of going forward, what the expectations are of the prospect going forward of the company itself. So the value goes up. Chances are that the expectation, the market expectation, is that the company is going to improve going forward, meaning higher dividends, and/or it's going to increase the price of the value of the stock. Stock market bubble, stocks are trading above their actual worth, and this has happened on more than one occasion, driven by investor optimism. They're irrational, think about things that happened before. It happened in 2000. It happened in the great the stock market crash in 1929. It's happened periodically, where you get investor enthusiasm, thinking everything is wonderful, and the bottom falls out. Kind of somewhat happened with that with the COVID crisis too. The bottom dropped out of the market. There was a crash, bubble burst, however you want to look at it. I don't like the term bubble, but it happens. It's just a way of describing it. And the idea, though, of course, is that the markets do come back from these crashes. Typically, they have been, at least historically. They have come back historically. Primary market investor buys securities from the issuer of those securities via an investment bank. These are initial public offerings. Again, IPO. When a corporation sells stock to the general public for the first time, key factor: cash from security sales go to an issuing company. And then there are ongoing sales of stock as well. Market for existing financial securities traded. These are on the secondary markets, meaning they're back and forth. You can buy. This is why you can buy and sell stocks or bonds in the marketplace out there. They are saleable. That's why we see prices for stocks and stock markets, etc. Means that that's what you can purchase that share of stock for, or the stock price per share, I should say. There are securities exchanges. Those are the markets, physical trading locations, over-the-counter markets, network of dealers, and pretty much everything has gone online, which is another thing to consider, but we'll leave it at that. Securities exchange, again, are marketplaces where members representing investors meet. These are stockbrokers, right? Listed market, NYSE, New York Stock Exchange, designated specialists buy or sell particular stock, etc. Network of dealers who buy over-the-counter, OTC, dealers who buy and sell stock of companies from inventory, whatever they have in their inventory. The dealer is the market maker. The dealer makes the market for whatever that stock is. If it's a small electronics company or a tech company or so on and so forth, it oftentimes goes through the OTC, like with the NASDAQ electronic marketplace for approximately 3,300 companies. Smaller companies, large companies, mid-sized companies, a lot of them are on NASDAQ. Brokerage firms and account executives, the stockbroker, again, licensed individuals who buy and sell securities for his or her clients, and they receive, of course, a commission. And stockbrokers like to see churning. They like to see buying and selling, because how they make money, it doesn't matter about the value of the stock or if the stock is going up or down in value. It's just that they make those trades. And that's kind of the role, if you will, of a stockbroker, is to facilitate, to make the trades for you, to bring the buyer and seller together, not take possession themselves, but to bring the buyer and seller together. That's something a little different when we talk about bonds, but we're sticking with stocks right now. Discount and full service broker versus online. Things have changed with this as well, but there are typically commissions that are associated with the stock transactions. So that has to all be considered in terms of your cost of ownership, if you will, which drives us to more points as we go through. Computerized transactions, the size of investment portfolio. Typically, when you're trading on your own, online, for example, the trade, the cost of commissions and trades and so on and so forth are typically less. Nonetheless, there are costs that are associated with this. And you've heard the expression, perhaps, a day trader, people that are trading stocks on a daily basis. Trading meaning buying and selling stocks, and this is something that has become, it always has been there, but it's become increasingly popular with being able to access accounts and different markets online. But it's also a very dangerous game oftentimes, but we'll leave it at that. Market order to buy or sell a stock at a current market value. Limit order to buy or sell a stock at a specified price, meaning if you're afraid that your stock price may fall below a certain level, you'll have a sell order in, or vice versa. If it falls below a certain point, you may have a buy order in, or if it, again, it all depends on what you have this set at. Stop loss orders to sell stock at the next available opportunity after its market price reaches that specified amount. In case of free fall market, there's an automatic sell features that are put into gear. Brokerage minimum commission $5 to $25 depending upon the number of shares of stock. Full service versus discount brokers. Full service fees are obviously greater than discount brokers fees. Online broker, little advice if you make your decisions. Long-term investment strategy, this is typical. Remember we talked about the time value of money. The longer you hold on to your investment, the greater the greater the interest, of course, the more quickly your money doubles. That rule of 70, rule of 72 rather. Buy and hold strategy, dollar cost averaging, meaning that you continue to you pay yourself first, not on on a regular basis, on a weekly, monthly basis, where you're contributing more and more to your investment portfolio. You're buying more and more stocks, in this case, bonds, mutual funds, etc. Direct investment, dividend reinvestment plans. That's where you automatically, if you receive a dividend, you automatically reinvest that. These are things that are kind of set up for you. Long-term technique again. It's invest equal dollar shares in the same stock at equal intervals. Goals: minimize average cost per share, avoid buying high or selling low. So you're going with the market in essence and trying to take advantage of that. Direct investment allows purchase of stock directly from a company. No broker or executive, so you can buy directly from a company. And the DRIP, or the dividend reinvestment plan, allows the option of reinvesting dividends to purchase more stock of the company. So again, this is dealing directly with the company, buying stock on margins. This is when you're borrowing money from a broker, and the margin setup is set by the Fed. Margin requirements: expecting price to increase, selling short, borrowing stock. Selling high and buying low. Bearish, expecting market price to decrease. Okay, so again, borrowing money from broker to purchase that stock with the expectation that the price is going to go up, and borrowing stock in order to buy it at a low price, to sell high, buy low. Bearish, your expectation that the market's going to decrease. So trading options, options and forward markets, they're different forward and futures markets, etc. It's right to buy an obligation, but not the obligation to buy or sell a stock at a predetermined price during a specified period of time. The call option is the right to buy, and the put option is the right to sell at a specific price, etc. Not for amateurs or beginning investors, and frankly, it's this is where hedging is concerned. There's a lot of strategy that's involved, and it gets quite complicated, quite complex. But it's an investment strategy that more sophisticated investors use. We'll leave it at that. So Corporations sell stock, a form of equity, to finance their business startup costs and help pay ongoing business costs. This is just the normal. It's an expensive proposition, but it's typically a way of financing that company, the company's growth. Common stockholders have a right to elect the board members so they can vote. Possible reason for stock investment include dividend income, appreciation, value, the two. So you want to either, your expectation is that you're going to be receiving dividends, or the value of the stock is going to go up, or both, that you can sell it at some point in time and realize what is called a capital gain, an increase in the value of the stock, and you realize that you cash in, if you will. Possibility also of gains through stock splits. Few corporations may issue preferred stock. Preferred stocks, again, their preference, they have received preferential treatment in terms of receiving a cash, their dividends. They've received their dividends first before the common shareholders, stockholders receive dividends. So if they're, say there's only a certain amount that can be given out as dividends, preferred stockholders receive their dividends first. Okay, so they're first in line, but their downside for a preferred stockholder is that they're not able to vote, if you will. So again, walking through the various aspects of this, you can do this. The learning objective is as we go through, and I'm cutting this short primarily because I want for you to understand that equities or stock is ownership in the company, meaning they're both bonds and stocks are ownership in the company, but the shareholder again is the owner in the company for a specific number of shares, a specific amount of the quantity, and versus a bondholder, you're an owner of the company, but you are guaranteed a certain income. There are no guarantees for income. There's no guarantee for a dividend, no guarantee that the price of the stock is going to increase. So that's the difference between a shareholder and the bondholder. Bondholder, there's some certainty, or there's a greater degree of certainty, but there's nothing certain. In the end, it all depends upon how the company is run, and and anyway, that's the takeaway on it.